Welcome to another episode. My name's Jose Najarro, and today we're going to take a look at Texas Instruments. They reported earnings today, January 22nd, and they're one of the first semiconductors to do so. So I was pretty excited to see how they went, how things went today. After hours, Texas Instruments is down about 1.3%. Current price after hours is $131.55. If we take a look at their earnings per share and revenue, Texas beat non-GAAP and GAAP earnings per share. GAAP earnings per share were $1.12 and it beat by 10 cents. Revenue was $3.35 billion. It beat by $140 million. But compare this year, quarter four to the same time last year, revenue is down about 10%. So now let's take a look at this company's information that they provided to the shareholders in their shareholder letter. So this shareholder letter talks about quarter four, and it also talks about their 2019 year, right? Because for quarter four, they do both quarterly and the annual data. So like I mentioned, revenue was $3.35 billion, net income of $1.07 billion, and earnings per share of $1.12. The earnings per share also included a 1 cent benefit for items that were not originally included in their guidance. But let's be honest, 1 cent in the $1.12 is not a big impact. The big highlights for this quarter is revenue is down 10% compared to the same time last quarter, and that's actually that's pretty scary. We're gonna take a little more look at the graphs, but it does seem like there is a bit of a slowdown for Texas Instruments at the moment. Texas Instruments is made up of three revenues: analog revenue, their embedded processing revenue, and then the other revenues. Analog revenue is down 5%, embedded revenue is down 20%. Compared to the same time last year ago, we're gonna see in a bit later how that breakdown is for the revenue. You're gonna see that analog is a huge portion compared to everything else. Cash flow for operations was $6.6 billion for the year. That's actually pretty good. This company has a very strong positive cash flow, and free cash flow for the year was $5.8 billion, which was about 40% of revenue. Again, for a company to have such a free cash flow of 40% of the revenue, that definitely shows that this company is running things very efficiently. They returned about $6 billion to owners in 2019, both through stock repurchases and dividend. Their dividends represent 52% of free cash flow. We're going to take a look at a little bit later on how that dividend and cash flow and repurchases were made. Now let's take a look. They gave us a quick guidance for next quarter. For the first quarter of 2020, revenue is expected to be $3.12 billion to $3.38. So if somewhere in the middle will be about $3.25 billion. And earnings per share of about 96 cents to $1.14. So what's that? About $1.05 in the middle. So if we take a look at 3.25 billion, and let's compare that to same time last year, where would I have that here? So here I have revenue for the quarter for Texas Instruments. And if we take a look at quarter one of 2019, quarter one of 2019 was almost $3.6 billion. So now for quarter one of 2020, you're expecting 3.25 billion. So we can see there is a slowdown happening. And if we take a look at the quarter 2 years ago of 2018, first quarter of 2018 was even higher than that at almost $3.8 billion. So 2018 quarter one was 3.8 billion. 2019 quarter one was about 3.6 billion. And they're saying quarter one of 2020 is going to be about 3.25 billion. So you can see there is a slowdown happening on this company. Now let's take a look at that earnings per share. Remember, they said earnings per share of an average of $1.05. So 2018 quarter one was $1.38. 2019 quarter one was $1.29, and now it's going to be somewhere around 105 if we take a look at the midpoint. So we can see that revenue is decreasing, and as well that earnings per share. Cash flow from operations. So cash flow, like they said, they had $6.6 billion of cash flow from operations for this year. Cash flow from operations from same time last year for 2018 was about $7.2 billion. So cash flow this year decreased about 8%. And free cash flow decreased about 4% this year. Free cash flow last year of 2018 was about $6 billion. Right now it's sitting at $5.8 billion. Next, we're going to take a look at how this company has returned to the shareholders. Dividend payments. Let's just take a look at annual data. Annual data for 2018, this company paid about $2.5 billion in dividend. In 2019, this company paid about $3 billion in dividends. So there was an increase of about 80% increase in dividends compared to last year. So that's pretty good. This company is definitely increasing its dividends. Stock repurchase though, stock repurchase last year was a lot more than this year. And that's actually, it kind of makes sense to me, right? Last year was when all this trade war panic was going on, and a lot of these companies had very low prices. So stock repurchase last year was $5.1 billion. Stock repurchase this year was almost $3 billion. So about a 42% decrease in amount of money that this company is spending on repurchase. So they definitely loaded the truck last year compared to this year. So this is a semiconductor company, and companies like this definitely need to focus on research and development. So I wanted to take a look at how their research and development cost were doing this year compared to the same time last year, just to make sure this company is keeping up with trends. And we can see last year this company spent $10.2 billion in R&D, and this year spent about $9.2 billion in R&D, so about $1 billion less. But remember, they took about a little over $1 billion less in revenue. So it would make sense that research and development also took a hit. But that $9 billion is still big. It's still a large amount. So that's pretty impressive that this company is spending a lot of money for research and development. Next, let's take a look at diluted earnings per share. So this company last year gave $5.59. Remember, I said there does seem to be a slowdown, and this year it produced $5.24. And let's actually take a quick look at Seeking Alpha. They usually give us estimates for 2019. They expected this company to give us about $5.17 of earnings per share. This company beat the expected. So it beat by 7 cents, I did. Yes, so it did $5.24 compared to the estimated $5.17. For 2020, for next year, they are expecting $5.06. So we can, again, continue to see that this company is seeing a bit of a slowdown compared to 2018. So 2018 seems to be the peak. Then 2019 slowed down. And now we're seeing 2020 is continuing to give us this slowdown. Forward PE ratios continue to be about 25. So that's pretty much, I think, around the average right now for these semiconductor companies. Next, let's take a look at diluted shares. At the end of 2018, this company had about 970 million shares outstanding in diluted outstanding shares. They did a lot of repurchasing throughout the year. So in the end of 2019, they have about 948 million shares. So they bought about 22 million shares this year. And here we can see the dividend difference, right? They did 77 cents per share last year, and this year they did about 90 cents per share. Next, we're going to take a look at this company's balance sheet. And to me, the balance sheet is definitely the best place to see how the company is truly doing. So we're going to take a look at 2018 and 2019. So cash and cash equivalents remain pretty much the same for both years. Last year, at the end of 2018, this company had $2.4 billion in cash and cash equivalents. This year, actually, this company is sitting at about the same $2.4 billion. So no change there. The biggest change in current assets was actually from short-term investments. Last year, this company had $1.8 billion in short-term investment, where right now it's sitting at $2.95 billion. So over $1 billion increase in short-term investments and flat levels in cash and cash equivalents. So this company is putting its money to work. So next, let's take a look at inventories before we look at total current assets. Inventories right now, we're sitting at $2 billion worth of inventory. Last year, we're sitting at $2.2 billion. This makes sense, right? If the company is expected to see a slowdown in their products being sold, we would expect them to have lower inventory than same time last year. Total current assets right now is sitting at about $8.8 billion, where same time last year was sitting at about $8.1 billion. So you can see this company has increased its total current assets. Next, let's take a look at the company's total asset. Total asset right now is sitting at $18 billion of total assets. The biggest change coming from total current assets, and total assets last year was $17 billion. So an increase of about about $800 to $900 million of assets increase this year compared to same time last year. And like I mentioned, one of the biggest changes was that total current assets. We see that huge increase in short-term investments that this company did not have last year. Assets are looking good, but the only way to really compare assets are by looking at the liabilities to see what the ratio is really at. All right, so the biggest change here in total current liabilities was they have less portion of long-term debt to pay off this year compared to the same time last year. And this is not the company's fault. This just depends on when they have to pay their bills. So last year they had to pay off some portion of a loan faster than this year. The main difference here is accounts payable, and accounts payable is when this company needs to pay its suppliers for the inventory or for the items, the raw materials. So last year this company paid about $478 million to its suppliers. This year it paid $100 million less at $388 million. But again, that's to be expected, right? Because this company had a slowdown, is expecting that slowdown, has that slowdown happening. So they're buying less inventory. So obviously you will see less value on accounts payable. So total current liabilities this year is sitting at $2.1 billion. Same time last year was about $2.5 billion. So we're seeing a decrease in total current liabilities, but we're seeing similar levels in total current assets compared to last year. So again, that's definitely a good thing to see. Next, we're going to take a look at long-term debt. This company last year had $4.3 billion in debt, in long-term debt. Right now, it's sitting at $5.3 billion. So that's about a $1 billion increase in long-term debt. So this company is actually increasing, is taking out loans. So it's something we're going to have to take a look in the 10Q report to see when this happens. Total liabilities at the end of this year was $9.1 billion. Same time last year was $8.1 billion. And we can see the major impact. So that's a $1 billion difference. The biggest difference comes from that long-term debt. So total liability increased a little bit numerically wise higher than total assets, but total assets is still a lot higher than total liabilities, almost a 2-to-1 ratio. So that's pretty good. And the total current assets compared to total current liabilities is almost a 4-to-1 ratio. So that's both, the balance sheet is looking pretty good for the company. Now remember, I told you guys that this company has 3 types of revenue coming from: analog devices, embedded processing, and other. And analog devices make up a huge portion, sitting at $2.5 billion. Embedded processing makes $0.6 billion, so $600 million, and other revenue makes up $220 million. So you can see the big boy is definitely analog devices, but analog decreased 5% this year compared to same time last year. Embedded processing decreased Q4 2019 20% compared to Q4 of 2018, and other decreased 24%. So you can see there is that slowdown happening with revenue. So what I mentioned before was the quarterly segment. Now let's just take a look at the annual segment to see how things are progressing in the total scheme of 2019. Analog made up $10.2 billion of revenue this year. Embedded made up $2.9 billion, and other made up $1.2 billion. So out of the whole, what is that, about 14 or 15 billion, 10 billion came from analog. So you can see analog revenue is a huge portion of this company's revenue. Analog revenue of 2019 dropped about 5%, embedded processing dropped about 17%, and other dropped about 15%. So again, you can continue to see that slowdown happening there. So that's it for this episode. We did see a few things. We saw that analog Texas Instrument is seeing a slowdown in their devices, in their revenue, and they're expecting 2022 to even be another slowdown. And we can see it here with earnings per share of 2019 lower than 2018, and analysts expect 2020 to be lower than the previous years. And we can see that Q1 estimates that they gave us are also lower than Q1 2019 and Q1 2018. So we are seeing that slowdown. This company is currently priced at about 25 forward PE ratio for 2019 and about 25 forward PE ratio for 2020. A little bit higher, more like 26. But that's because, right, we're expected to see that revenue slow down. But overall, this company definitely has a very, very strong balance sheet. It has a very strong shareholder return. And yeah, so let me know what you guys thought about this company. Make sure to post in the comments. I'll probably try to do a video a day right now that earnings season is happening. And I'll do a quick review like this. After earnings season is done, I'm going to go back to my previous format where I give a more in detail an analyst compared to what I'm doing right now. Right now, I'm just providing you guys with the information that's coming through. Later on, I'll be able to read the 10Q reports and be able to do heavier research. I'll be able to do heavier research on each specific company. So take care, guys. Have a good night. Make sure to subscribe. Make sure to post in the comments. Give me a thumbs up. Share with your friends. So take care.